Welcome to MBA 620, Financial Decision Making. My name is Dr. Richard Works, and I will be your instructor for this course. In this lesson, we will be covering Project 5, Financial Decision Making for Managers. Cash flows between the firm and its stakeholders and owners. If you look at the arrow labeled A, you will see that making business decisions is all about cash flows, because only cash can be used to pay bills and buy new assets. Cash initially flows into the firm as a result of the sale of goods or services. The firm uses these cash inflows in a number of ways: to provide wages and salaries, to buy supplies, to pay taxes, and to repay creditors. Now, if you look down in the blue section at B, you will see any cash that is left over can be reinvested into the business or paid as dividends to stockholders. The finance balance sheet. The market value of a firm's assets, which equal the present value of the cash flows those assets are expected to generate in the future, must equal the market value of the claims on those cash flows, the firm's liabilities and equity. Self-financing and donations from friends and family is a common way to start a business. Another way would be getting small short-term loans. Also, small business grants are available from foundations and various government organizations. Incubators provide resources and support in exchange for equities in the new company. And then we have angel investors and venture capitalists, as well as crowdfunding. There are many different ways to source capital if you would like to start a business. What is cost of capital? This is the discount rate used to calculate the net present value of your project. It is also the required rate of return of a project, and it is the opportunity cost for the holders of the firm's securities. It can be estimated by taking the weighted average cost of each security issued by the firm. Estimating the cost of capital. If we divide the cost of capital into debt and equity portions of the firm, then we can use the appropriate formula to arrive at the weighted average cost of capital. Cost of capital and risk. When the cost of capital is being used as a discount rate to evaluate a new project, the manager needs to take the riskiness of the project into consideration. What is risk? Risk is uncertainty. Uncertainty in future cash inflows due to market conditions that affect the revenue, consumers' ability to pay, operational risk, and interest rate risk. Also, uncertainty in future cash outflows due to the company's ability to pay, and again, interest rate risk. Risk and return trade-off. People do not want to lose money. A person would prefer a higher risk opportunity if the probability of an adequate return is high enough. A higher risk investment must offer a potential return high enough to make it as attractive as the lower risk alternative. The potential return a person requires depends on the amount of risk, the probability of being dissatisfied with an outcome. This graphic will give you a comparison of risk and returns of various equity markets. I will pause here for you to review. How to measure return. Expected return and realized return. First, expected return. This is estimated or predicted before an outcome is known. The expected return is equal to the probability of the return multiplied by the return. Realized return is calculated after the outcome is known. The realized return is a selling price minus the purchase price divided by the purchase price. Holding period return. Ella buys a stock for $26. After 1 year, the stock price is $29, and she receives a dividend of 80 cents. What is her return for the period? After reviewing this formula, we see that her return is 14.62%. Expected return. There is a 30% chance that the total return on a Dell stock will be negative 3.45%, a 30% chance it will be plus 5.17%, a 30% chance it will be plus 12.07%, and a 10% chance that it will be plus 24.14%. Therefore, calculate the expected return. This is an example of calculating the expected return with the probabilities as well as the percentages. The most commonly used terms in measuring risk are volatility, variance, standard deviation, and beta. This graph shows the mindset of uncertainty. The greater risk, the greater reward. No risk, no reward. This graph shows a standard deviation and width of a normal distribution. You may remember something like this from your economics or statistics class. When you compare the standard deviations of two investment opportunities, the larger standard deviation is more riskier than the lower standard deviation. This graph shows the monthly returns for Apple stock and the S&P 500 index. As we can see, the returns of shares on individual stocks tend to be much more volatile than the returns on a portfolio of stocks, such as the S&P 500. Variance and standard deviation as measures of risk. To calculate the variance, we square the difference between each possible outcome and the mean, and then we multiply each squared difference by its probability of occurring, and then we add them together. If all possible outcomes are equally likely, the formula becomes as you see on the screen. To calculate the standard deviation, all you do is take the square root of the variance. Risk and diversification. Diversification eliminates unique risk, but there is some risk that diversification cannot eliminate. This is called market risk. By investing in two or more assets whose returns do not always move in the same direction at the same time, investors can reduce the risk in their investment portfolios. Diversification can virtually eliminate unique risk to individual assets, but the risk common to all assets in the market remains. Risk that cannot be diversified away is non-diversifiable or systematic risk. This is the risk inherent in the market or economy. Diversification only makes sense to investors, but not to firms, because investors can diversify easily and cheaply, but it is more expensive for firms to diversify its product lines. Therefore, investors will not pay extra to the firms they invest in to diversify for them, nor will they pay less for firms not being diversified. This means that a firm's value would not increase or decrease depending on its degree of diversification. Common stock and preferred stock. These represent ownership in a corporation. They are the two types of equity securities that are most frequently used. Dividend payments do not affect a firm's taxes. Common stock and preferred stock have limited liability, so claims made against the corporation cannot include a stockholder's personal assets. Also, they are generally viewed as perpetuities because they do not have a maturity date, and they are no guaranteed dividends, but dividends are promised to preferred stockholders. Market information is used to estimate the cost of equity. Two alternative methods for estimating the cost of common stock include the capital asset pricing model and the constant growth dividend model. The most appropriate method will depend on what information is available and how reliable the analyst believes it is. Step 1 in our project will be to make cost of capital decisions. Weight of equity. Equity is another option for borrowing and investing at the organizational level. The weight of equity in a company's total capital is calculated by dividing the market value of the company's equity by the sum of the market values of equity and debt. As an organization, one of the options for sourcing capital is to pursue debt. This can either be through taking out a loan or a put option on selling corporate bonds. These options tend to have lower interest rates and long payback periods. Debt is paid back first in the case of bankruptcy, lowering its risk as an investment. The weight of debt component is calculated by dividing the market value of the company's debt by the sum of the market values of debt and equity, and the formula is on the screen. The equities cost is calculated using the capital asset pricing model, and that formula is now on the screen, and I will give you a moment to review this. The cost of capital is calculated as last fiscal year end interest expense divided by the book value of debt. That would be your cost of debt. The capital asset pricing model is used to determine the required rate of return on an asset, taking into account the asset's sensitivity to systematic risk. And the formula is on the screen. All about beta. This identifies comparable companies with publicly traded stocks that is in the same business or that has a similar amount of debt. It uses an average of betas for public firms in the same industry. If beta is greater than 1, the stock is more volatile than the market. If beta is less than 1, the stock is less volatile than the market. Leveraged beta is the market beta, considering the capital structure of the firm. Unleveraged beta removes the influence of debt out of the beta, enabling comparison between companies. Market risk premium cannot be directly observed since we do not know the rate of return investors expect for the market portfolio. Market risk premium usually estimates the average risk premium investors have actually earned in the past as an indication of a risk premium they might require today. The CAPM model has a few assumptions, including many investors who are all price takers, meaning financial markets are competitive. 2. All investors plan to invest over the same time horizon. 3. No distortionary taxes or transaction cost. 4. All investors can borrow and lend at the same risk-free rate. 5. Investors only care about expected return and variances. 6. All investors have the same information and beliefs about distribution of returns. And 7. A market portfolio that determines beta consists of all publicly traded assets. The constant growth dividend model. I will give you a moment to review this material because it's mainly based on the formula. The constant growth dividend model is useful for a firm that pays dividends that will grow at a constant rate. In practice, most people use CAPM to estimate the cost of equity if the result is going to be used in a discount rate for evaluating a project. Company debt can include bank loans and corporate bonds. Estimating the cost of debt. A publicly traded bond's cost of debt is the yield to maturity. For private debt, you will need to check with the bank to see what rate that they would charge if you decided to refinance today. The required rate of return by investors is not often directly observable. Therefore, the market value of the security is often used to estimate the required rate of return. For cost of debt estimation, long-term debt is of interest because these debts can be considered as permanent since firms often use new debts to pay off old ones. Interest rates that a firm is paying on its outstanding debt does not necessarily reflect its current cost of debt. The current cost of long-term debt is the appropriate cost of debt for WACC calculations. WACC is the opportunity cost for capital for the firm's investors as of today. Use yield to maturity for cost of debt, adjusting for the tax deductibility of interest on debts. The yield to maturity is the internal rate of return of an investment if the investor holds the bond until maturity and if all payments are made as scheduled. It takes into account the time value of money and the purchase period of the bond. The current yield to maturity of a bond reflects the required rate of return for the bond holders. Therefore, it is used to estimate the cost of debt for a company. The after-tax cost of interest payments equals the pre-tax cost times 1 minus the tax rate. Debt ratings are assessments of creditworthiness of a bond or a company, namely the likelihood that the company defaults on its debt or obligations. And some of the popular agencies for these credit ratings are the Standard & Poor's and Moody's. Here we see the various categories of credit ratings. For Moody's, it goes from AAA down to C, and for Standard & Poor's, it goes from AAA down to D. Weighted average cost of capital, otherwise known as WACC. The weighted average cost of capital is a calculation of the various required rate of returns on a project, which determines the profitability required to break even. The weighted average cost of capital normalizes the cost of capital by combining the interest rates being incurred from both debt and equity. Limitations of WACC. A firm's WACC should be used to evaluate the cash flows of a new project only if the level of systematic risk for that project is the same as for the company's portfolio. A firm's WACC should be used to evaluate a project only if that project uses the same financing mix, which is the same proportions of debt, preferred shares, and common shares used to finance the firm as a whole. Alternatives to WACC. You can use a public firm that is in a business that is similar to the project. However, such a company is often quite difficult to find. Or you can classify projects into categories based on their systematic risk and then specify a discount rate for each category. Step 2 in our project is to make capital budgeting decisions. Under the Modified Accelerated Cost Recovery System, the capitalized cost of tangible property is recovered by annual deductions for depreciation over a specified period of time. The deduction for depreciation is computed under one of two methods: a declining balance switched to a straight line, or only a straight line. For this project, use the Modified Accelerated Cost Recovery System table and the WACC formula to answer questions 1 and 2. The salvage value is the estimated value that the owner is paid when the item is sold at the end of its useful life and is used to determine the annual depreciation. The salvage value is used to determine the annual depreciation in the accounting records, and the salvage value is used to calculate depreciation expense on the tax return. The value is based on the estimate of the asset's value, or the value that can be determined by the regulatory body such as the IRS. The salvage cash flow is calculated as the expected value of the equipment before tax minus the marginal tax rate multiplied by the expected value of the equipment before tax minus the marginal tax rate. Operating cash flow. These are the fundamental relationships that structure so many financial decisions, most of which involve a series of cash inflows and outflows. Understanding these relationships can be a tool to help you answer some of the most common financial questions about buying and selling liquidity, because loans and investments are so often structured as annuities and certainly take place over time. The net present value is calculating the investment's net value added to the cash flow of the firm. If the net present value is greater than 0, then we do the investment. To find the net present value, you identify the amount and the timing of the cash flows required over the life of the investment. Then you establish the appropriate interest rate to be used for evaluating the investment. This is typically called the required rate of return. You calculate and evaluate the net present value, and if the net present value is greater than 0, then you accept the project. On the screen now is a mathematical formula for calculating the net present value. In a similar fashion, you can also calculate the net present value for projects that are generating revenue at varying rates over time, and that formula is also on the screen. Calculating the net present value of a project. I will pause a moment for you to review this because it is something that you will need to see to understand. Here is a timeline with expected cash flows. The cost of capital is 50%. Please put the cash flow in Excel and calculate the net present value of this project. And once you complete that, this would be your outcome. The net present value of a project represents the current value of the project after taking into account the expected cash flow and the cost of capital. The net present value of a project is the difference between the present values of its expected cash inflows and expected cash outflows. Positive net present value increases shareholders' wealth, while a negative net present value decreases shareholders' wealth. Next, we will talk about the 5-step approach. Step number 1 is to estimate the project cost. First, we identify and add the present value of the expenses related to the project. Sometimes there are projects whose entire cost occurs at the start of the project, but many projects have costs occurring beyond the first year. The cash flow in year 0 on the timeline is negative, indicating the outflow. Step 2 is to estimate the project's net cash outflows. Both cash inflows and cash outflows are likely to be in each year of the project. Estimate the net cash flow for each year. Include the salvage value of the project in its terminal year. Step 3. Determine the project risk and estimate the cost of capital. The cost of capital is the discount rate used to determine the present value of the expected net cash flows. The riskier the project, the higher the cost of capital will be. Step 4 is to compute the project's net present value. Determine the difference between the present values of the expected net cash flows from the project and the expected cost of the project. Step 5 will be to make a decision. Accept the project if it has a positive net present value. Reject the project if it has a negative net present value. A summary of the net present value method. Again, if the net present value is positive, you accept it. If the net present value is negative, you reject it. Some key advantages are it uses the discounted cash flow valuation technique to adjust for the time value of money. Also, it provides a direct dollar measure of how much a capital project will increase the value of the firm. And lastly, it is consistent with the goal of maximizing a shareholder's value. A key disadvantage, though, is that it can be difficult to understand without an accounting and finance background. The internal rate of return is a metric used in capital budgeting to estimate the profitability of potential investments. Internal rate of return is a discount rate that makes the net present value of all cash flows from a particular project equal to zero. When calculating the internal rate of return, expected cash flows for a project or investment are given, and the net present value equals zero. The initial investment for the beginning period will be equal to the present value for the future cash flows of that investment. Hence, the net present value would be equal to zero. However, for our project, use the Microsoft Excel function IRR. The internal rate of return is the discount rate that makes the project have a net present value equal to zero. A project is acceptable if the internal rate of return is greater than the firm's cost of capital. The internal rate of return is an important and legitimate alternative to the net present value method. However, to make our life easier, again, we will use Microsoft Excel for the calculations. As you know, calculating the internal rate of return by hand would be tedious. The trial and error method can take a long time and be quite frustrating. If you know the approximate rate and all the cash flows, then you can use a spreadsheet formula to get your answer instantly. In capital budgeting, senior leaders would like to know the returns on investments, and the internal rate of return is one method that allows them to compare and rank projects based on their project yield, and the one with the highest internal rate of return is usually preferred. However, using the net present value works better when a project's discount rate is not known. The internal rate of return has to be compared to the discount rate to gauge the project's feasibility. If the internal rate of return is higher than the discount rate, it is a good project to pursue. If a project's net present value is above zero, it is financially worthwhile. When projects are independent and the cash flows are conventional, the internal rate of return and the net present value methods both agree. A conventional project has an initial outflow to begin and net inflows each year thereafter. Unconventional cash flows may exhibit many patterns. It could be a positive initial cash flow followed by negative net cash flows, or you could have positive and negative net cash flows, or it could be conventional except for a negative net cash flow at the end of the project's life. With unconventional cash flows, the internal rate of return technique may provide more than one rate of return. This makes the calculation unreliable, and it should not be used to determine whether the project should be accepted or rejected. This is an example of the net present value profile for a gold mining operation. A gold mining operation has unconventional cash flows. Because there are two cash flow sign reversals, we end up with two internal rate of returns, 16.05% and 55.65%. Therefore, neither of them are correct. In situations like this, the internal rate of return provides a solution that is meaningless, and therefore the result should not be used for capital budgeting decisions. The payback period is the amount of time it takes for the sum of the net cash flows from a project to equal the project's initial investment. The payback period can serve as a risk indicator, meaning the quicker the project's cost is recovered, the less risky the project. It is also a decision criteria. A payback period shorter than a certain amount of time would be preferable. Also, it is one of the most widely used tools for evaluating capital projects. This graphic shows the net and cumulative net cash flows for the proposed capital project with an initial cost of $70,000. The cash flow data are used to compute the payback period, which is 2.5 years. This slide right here shows how we got the 2.5 years on the previous screen. To compute the payback period, estimate the project's cost and its future net cash flows. Future cash flows are discounted by the firm's cost of capital. The major advantage of the discounted payback is that it tells management how long it would take for the project to reach a positive net present value. This graphic shows the discounted payback period, cash flows, and the calculations. I will pause to give you a moment to review. The ordinary payback period is widely used in business because it is easy to calculate and it provides a simple measure of an investment's liquidity risk. The ordinary payback period ignores the time value of money. It has no economic rationale that makes the payback method consistent with shareholder wealth maximization. Its biggest weakness is its failure to consider cash flows after the payback period. This graphic summarizes evidence from 2 studies that examine the use of capital budgeting techniques by businesses. As you can see, over time, more firms have come to use the net present value and the internal rate of return techniques. Surprisingly, though, even in 1999, 20.3% still computed the accounting rate of return. Step 3 in this project will be to discuss capital budgeting. Capital budgeting is a process in which a business determines and evaluates potential large expenses or investments. These expenditures and investments include projects such as building a new plant or investing in a long-term venture. Often, a company assesses a prospective project's lifetime cash inflows and outflows to determine whether the potential returns generated meet a sufficient target benchmark, also known as an investment appraisal. Key reasons for making capital expenditures. 1. Renewal. Equipment needs to be repaired, overhauled, rebuilt, or retrofitted. These decisions typically do not require an elaborate analysis and are made on a routine basis. 2. Replacement. Equipment can malfunction or become obsolete. These decisions typically originate at the plant level. 3. Expansion. Strategic decisions which require detailed, complex analysis. 4. Regulatory. And 5, which is cash flows that are hard to estimate and therefore decisions will be more subjectively than analytically. How to decide whether to make a capital expenditure. Number 1, use the net present value method. Use the cost of capital to discount the cash flow of a project. Then, choose a project with a positive net present value. Or, use the internal rate of return method. Calculate the rate of return of a project and choose the highest one or the one that has the higher rate of return than the cost of capital. Or 3, use the payback period method. Calculate how long it takes for the project to pay itself back, then choose the one with the shortest payback period. Step 4 in this project will be to prepare the executive summary. As with the previous projects, please prepare your executive summary to include the purpose, the problem, the method of analyzing the problem, the results of the analysis, the recommendations, and you can provide data or graphics to support your claim. Step 5 in this project will be to resubmit your skills gap analysis. Now that we are at the end of the semester, please submit an updated skills gap analysis so that we can compare before and after. That would be all for this lesson. Thank you very much for watching.